Hi, I'm Paul Zweven of the Zweven Group at Prudential Douglas Elliman, and we are on N2K.TV. I'm here with a very, very, very impressive person, Lenny Holler. Hi, Lenny.
Hello, Paul. How are you?
I'm very good. I'm very good. So, what company do you work for, Lenny?
I work for DE Capital Mortgage, which is an affiliate of Wells Fargo.
Very interesting. And what do you do there?
I arrange residential financing, mostly on co-ops and condos and single-family residences.
Very interesting. So Lenny sits about 3 feet away from us at 1995 Broadway in our office, and every day I learn something from him. There has been a very, very interesting term that's come up over the last year or so, and it's called Fidelity Bond insurance. And I have a feeling that a lot of you people out there don't know what it is. I didn't know what it was. Lenny, why don't you school us?
Sure. So Fidelity Bond insurance is a type of coverage that co-ops and condos have, that banks require them to have, that protects against employee dishonesty, particularly malfeasance by the managing agent.
Okay. I guess the biggest thing is that, last year we had a deal where we couldn't close on the loan because of the Fidelity Bond insurance, and I went to you and I was just like, how can we fix this? So what are the ways that that a building can get more bond insurance?
Well, in general, the requirements are you need 3 months of the past year's maintenance. So, for instance, if the building had $2 million of maintenance, the required Fidelity Bond insurance coverage would be $500,000.
Okay.
Now, there are also some exceptions to that rule. In particular, if you have a situation where the financial controls of the co-op or condo are very strong, then you potentially can lower that requirement. So, for instance, if there's a separate reserve account and a separate working capital account, and the managing agent cannot draw checks against the reserve account, and only the co-op can, or if there are multiple people from the co-op that can write checks, but not the managing agent on the reserve account, you can have those financial controls can reduce the requirement up to a point of maybe 80% of 2 months worth of maintenance, which in this case would be $267,000 rather than $500,000.
Okay, and for a $500,000 Fidelity Bond, what does that cost the building per year? Is it a ton of money?
It's really not that expensive.
Okay.
It's really not that expensive.
Okay. So, I guess that, the most important thing is that we all know what Fidelity Bond insurance is because it's going to be coming across every single loan, or not every loan, but just about every loan in New York City. And this was great, and I know you have a famous quote. So what is it?
Well, remember, holler if you need a mortgage.
Thanks, Lenny.